For 40 years, Western economists told you China would become the world's largest economy by 2030. They pointed to GDP growth rates of 10%. They showed you gleaming skyscrapers in Shanghai. They measured the expanding middle class, the infrastructure build-out, the manufacturing dominance. They called it unstoppable. They were wrong. Not because China failed to grow. It grew faster than any nation in human history. Not because China lacked ambition. Beijing executed the most aggressive industrialization program the world has seen since Stalin's 5-year plans. Not because Chinese workers lacked discipline. They built more high-speed rail, more bridges, more airports in 30 years than Europe built in a century. China's economic model did not fail. It succeeded, and success killed it. The engine ran out of road. Here's what your financial news did not explain. Every economic miracle in modern history has followed the same arc. Rapid growth, asset bubble, demographic peak, debt saturation, collapse. Recovery takes decades, if it comes at all. Japan traced this arc from 1955 to 1990. South Korea traced it from 1965 to 1997. China began tracing it in 1978. The endpoint arrived in 2024. The numbers tell a story the headlines obscure. Evergrande, the property developer, filed for bankruptcy protection with over $300 billion in liabilities. Country Garden, once Asia's largest developer by sales, defaulted on bond payments. Vanke, Sunac, and Kaisa followed into distress. Across 70 major Chinese cities, housing prices fell for the first time in a generation. Youth unemployment crossed 20% before Beijing stopped publishing the data. These are not random market corrections. These are the documented symptoms of a structural collapse. The machinery of Chinese growth has seized. To understand why requires looking at what Chinese growth was built on. 3 pillars held up the system: export-led manufacturing, real estate development, and debt-financed infrastructure. Each pillar now cracks under pressure it was never designed to bear. Export-led manufacturing worked when Chinese wages stayed low and Western consumers kept spending. Chinese wages have risen 400% since 2000. Western consumers carry record household debt. The arbitrage closed. Real estate development worked when urbanization continued, and families kept buying apartments as investment vehicles. Urbanization has plateaued at 65%. Families now hold an estimated 70% of their wealth in property assets whose values are falling. The buyers disappeared. Debt-financed infrastructure worked when each new highway, bridge, and railway generated economic returns exceeding the borrowing cost. China has built infrastructure beyond its immediate needs. Ghost cities dot the interior provinces. High-speed rail lines connecting small cities operate at losses. The returns turn negative. This is not a recession. Recessions end in quarters. This is a structural transformation, and structural transformations take decades. The reason you need to understand this goes beyond academic interest. China manufactures 30% of global goods. China consumes 50% of global industrial metals. China holds over $800 billion in U.S. Treasury securities. China produces 80% of the world's solar panels, 60% of electric vehicle batteries, 90% of rare earth processing capacity. When China's economy contracts, your economy feels it. The prices you pay at stores change. The interest rates on your mortgage shift. The job security you expect alters. The retirement funds you contribute to rise or fall based on decisions made in Beijing, Shanghai, and Shenzhen. Welcome to Rashii Historical. We follow the money, trace the power, and expose the history they never taught you in school. The Chinese economic crisis is not a future possibility. It is a present reality unfolding in documented data across official statistics, corporate filings, satellite imagery, and financial records. Over the next chapters, you will see exactly how this crisis mirrors Japan's 1990 collapse, why the parallels extend beyond surface similarities to structural foundations, and what this means for your money, your country, and your future over the next 2 decades. The story begins 34 years ago in Tokyo, where the world watched the first version of this script play out. On December 29th, 1989, the Nikkei 225 stock index closed at 38,915. This was the peak. Over the next 2.5 years, the index fell to 14,309. It did not return to its 1989 high until February 2024. 34 years of stagnation. The Japanese called them the lost decades, plural. 2 generations of workers entered an economy where wages stayed flat, opportunities contracted, and the promise of continuous improvement vanished. Before the collapse, Japan looked invincible. Western business magazines ran covers asking if Japan would buy America. Japanese firms purchased Rockefeller Center, Columbia Pictures, and Pebble Beach Golf Course. The Imperial Palace grounds in Tokyo were assessed at a higher value than all the real estate in California combined. This was not irrational exuberance from unsophisticated investors. Japan had executed an economic transformation unmatched in modern history. From the ashes of 1945, Japan rebuilt into the world's second-largest economy by 1968. Japanese cars dominated American roads. Japanese electronics filled American homes. Japanese manufacturing techniques became the global standard. The success was real. The bubble was also real, and the bubble grew from the success. Here is the mechanism. As Japanese exports generated enormous trade surpluses, dollars and other foreign currencies flowed into Japan. The Bank of Japan converted these to yen, expanding the monetary base. Interest rates stayed low to prevent yen appreciation from damaging exporters. Low interest rates made borrowing cheap. Cheap borrowing fueled speculation. Land prices in Japan rose 5,000% between 1956 and 1990. Not 500%, 5,000%. Commercial property in central Tokyo traded at values assuming rent increases of 20% annually forever. Banks accepted this inflated land as collateral for additional loans. Loans funded more land purchases. Prices rose further. The Ministry of Finance encouraged this. Banks operated under implicit government guarantees. Regulators looked away from questionable lending practices. The incentives pointed toward expansion, concentration of assets, and leverage upon leverage. By 1989, Japanese banks held a majority of the world's largest bank positions by assets. These asset values rested on property collateral valued at bubble prices. When property values fell, bank assets fell. When bank assets fell, lending contracted. When lending contracted, economic activity slowed. When economic activity slowed, property values fell further. The economist Richard Koo named this a balance sheet recession. In a normal recession, demand falls, but credit remains available. Recovery happens when demand returns. In a balance sheet recession, assets fall below liabilities across the entire corporate and household sector. Everyone owes more than they own. No one wants to borrow because they focus on paying down existing debt. Banks do not want to lend because collateral values have collapsed. Monetary policy loses traction. The Bank of Japan cut interest rates to zero. Growth did not return. The government ran fiscal deficits year after year. Growth did not return. Japan's government debt rose from 60% of GDP in 1990 to 260% of GDP by 2023. Growth did not return. The demographic turn accelerated the stagnation. Japan's working-age population peaked in 1995. Each year after, the labor force shrank. Fewer workers meant lower output potential. An aging population spent less on goods and more on healthcare. The tax base contracted while pension obligations expanded. Japan entered the bubble with a fertility rate of 1.57 children per woman. By 2023, the rate had fallen to 1.20. The population pyramid inverted. More retirees drawing pensions, fewer workers funding the system. What made the Japanese crisis permanent rather than cyclical was the combination of debt overhang and demographic decline. Either problem alone might have found resolution. Together, they created a trap. Growth requires either more workers or higher productivity per worker. Debt overhang suppresses investment in productivity-enhancing capital. Demographic decline reduces workers. The economy cannot grow its way out. It cannot inflate its way out because an aging population fears inflation more than stagnation. It cannot default its way out because the debt is held domestically, and default would wipe out the savings of the elderly. Japan adapted. Living standards remained high by global measures. Social stability held. Crime stayed low. Infrastructure remained excellent. But the dynamism disappeared. Young Japanese faced a future of limited advancement. Companies stopped hiring permanent employees, shifting to contract workers with no job security. Marriage and birth rates fell further as economic precarity spread. The Japanese template contains specific elements worth isolating: export-led growth generating currency inflows, low interest rates to manage currency appreciation, asset bubble in real estate fueled by cheap credit, banks using inflated land as collateral for more lending, government implicit guarantees encouraging risk-taking, demographic peak coinciding with asset peak, balance sheet recession preventing normal recovery, decades of stagnation despite aggressive policy response. Every single element appears in China's economic structure. The timing differs. The scale exceeds Japan by a factor of 10. The political system creates different response options, but the underlying dynamics match. In 1998, China privatized its housing market. Before this reform, the state allocated housing. After, citizens purchased apartments on the open market. This single policy change created the largest asset bubble in human history. To understand the scale, consider one data point. In 2020, Chinese residential real estate was valued at approximately $62 trillion. This exceeded the combined value of all residential real estate in the United States, Europe, and Japan. The entire American housing stock was worth $33 trillion. China's economy produced 70% of American GDP, but held twice the housing value. This was not a sign of Chinese prosperity. It was a sign of Chinese distortion. Housing prices in Tier 1 cities like Beijing and Shanghai reached 40 to 50 times median annual income. In New York and London, the ratio runs 10 to 15 times income. Chinese families saved for decades to afford down payments. They purchased apartments in buildings not yet constructed, trusting developers to complete projects years in the future. The developers took this trust and leveraged it. Evergrande, at its peak, held over 1,300 projects across 280 cities. The company borrowed against future apartment sales to fund current land purchases. It pre-sold apartments, collected deposits, and used the cash to start more projects before completing existing ones. This worked as long as prices rose and buyers kept arriving. Evergrande's liabilities exceeded $300 billion when the company filed for bankruptcy protection in August 2023. This figure exceeded the GDP of Vietnam. Over 1.5 million Chinese families had paid deposits for apartments Evergrande never finished. Country Garden followed. Once valued at over $50 billion, the company defaulted on bond payments in October 2023. Country Garden had exposure to 3,000 projects across China, concentrated in lower-tier cities, where demand collapsed first. Vanke, long considered the most conservatively managed major developer, announced distress in 2024. Sunac, Kaisa, Fantasia, and Shimao had already defaulted. By early 2024, developers accounting for 40% of Chinese housing sales had entered some form of restructuring, default, or distress. The ripple effects moved through the economy. Construction employs roughly 15% of China's workforce directly or indirectly. Steel, cement, glass, and copper production depends on construction activity. When buildings stopped, factory orders fell. When factory orders fell, workers lost jobs. When workers lost jobs, they stopped buying apartments. The cycle reinforced itself. Local governments faced their own crisis. For decades, Chinese cities funded themselves through land sales. A local government would acquire rural land, reclassify it for development, install basic infrastructure, and auction parcels to developers. This land finance system generated 30 to 40% of local government revenue in many cities. When developers stopped buying land, local revenues collapsed. The cities had borrowed against expected future land sales through local government financing vehicles. These LGFVs accumulated debt estimated between $7 and $11 trillion, depending on which obligations get counted. The debt-funded infrastructure, some useful, some wasteful. The returns often fell below the borrowing cost. The structure was tenable only while land prices rose. Official Chinese statistics showed housing prices falling across 70 major cities tracked by the National Bureau of Statistics. By early 2024, year-over-year declines ran 5 to 10% in most cities, with steeper falls in smaller markets. These official figures likely understated actual declines. Developers offered discounts, free parking spaces, and other incentives not captured in headline prices. The stock of unsold apartments reached record levels. Estimates placed unsold and unoccupied housing units at 90 million or more. This inventory would take years to absorb under normal sales rates. But sales rates were not normal. They had fallen 40 to 50% from peak levels. Household wealth destruction followed. Chinese families held an estimated 70% of their wealth in property. When apartment values fell 20%, household wealth fell 14%. When wealth falls, spending falls. When spending falls, businesses earn less. When businesses earn less, they cut jobs. When jobs disappear, more families default on mortgages. The spiral feeds itself. The government response revealed the structural depth of the crisis. Beijing cut interest rates, loosened purchase restrictions, reduced down payment requirements, and directed banks to extend credit to developers. These measures would have reignited a normal housing slowdown. They failed to stabilize this market because the problem was not cyclical. The problem was structural. China had more housing than it needed. The population was shrinking. The working-age population had been shrinking since 2011. Young people in cities faced unemployment exceeding 20%. Who would buy the apartments already built, let alone the ones under construction? In 2022, China's population declined for the first time since the Great Famine of 1961. The National Bureau of Statistics reported 850,000 fewer people at year-end than at year start. In 2023, the decline accelerated to 2 million. Projections from the United Nations Population Division show continued decline through the century. These numbers represent a civilizational shift. For 3,000 years, China held the world's largest population. India passed China in 2023. By 2050, China's population will fall below 1.3 billion. By 2100, projections show populations between 500 million and 800 million, depending on fertility assumptions. The cause is documented in fertility data. Chinese women now average between 1.0 and 1.2 children over their lifetimes. This rate stands among the lowest ever recorded for a major nation. Replacement level, the rate needed for population stability, is 2.1 children per woman. China produces half the babies required to maintain its current population. The one-child policy, enforced from 1980 to 2015, initiated the collapse. Generations grew up as only children. The cultural norm shifted towards smaller families. The policy ended in 2015, but fertility continued falling. Beijing allowed 2 children, then 3 children, then offered subsidies and incentives for larger families. Women kept having fewer babies. Economic pressures drive the current low fertility. Housing costs consume enormous portions of household income. Education costs for one child can exceed annual salaries. Young people face a job market offering fewer opportunities than their parents enjoyed. The cost of raising children exceeds what most couples can afford. The 4-2-1 structure captures the demographic trap. One young adult supports 2 parents and 4 grandparents. The burden falls on shrinking cohorts of workers. Each generation entering the workforce is smaller than the one retiring out of it. Working age population, people between 15 and 64, peaked in China in 2011. Since then, the workforce has contracted by tens of millions. By 2050, projections show 200 million fewer working-age Chinese than today. This is not a projection requiring complex models. These people were not born. They will not appear. Labor force decline directly caps economic growth. Economy grows through two mechanisms: more workers or higher output per worker. When worker numbers fall, productivity must rise faster to compensate. But China's productivity growth has slowed along with overall growth. The catch-up gains from moving rural workers to urban factories have largely been captured. Further productivity gains require technological advancement, innovation, and capital investment. Debt overhang constrains capital investment. Trade tensions constrain technology access. The dependency ratio measures workers relative to non-workers. China's ratio will deteriorate faster than any major economy in history. Japan aged gradually over decades. China will age in a compressed time frame because the one-child policy created a sharp discontinuity in birth rates. By 2050, China will have roughly 500 million people over age 60. This cohort will require pensions, healthcare, and social support. The fiscal burden will exceed current projections because the working-age population paying taxes will shrink while the retiree population drawing benefits will grow. Automation offers partial mitigation. China has installed more industrial robots than any nation. But robots do not buy apartments, pay income taxes, or fund pension systems. Automation generates productivity gains for capital owners. It does not solve the fiscal mathematics of more retirees and fewer workers. Japan's demographic trajectory provides a preview. Japan aged before China and with higher per capita wealth. Japan entered demographic decline with a GDP per capita of approximately $40,000. China enters demographic decline with GDP per capita around $12,000. Japan was rich before it got old. China is getting old before it gets rich. This phrase, old before rich, describes the core trap. Wealthy nations can fund generous retirement systems because decades of growth created accumulated capital. Nations that age before accumulating sufficient wealth face harder choices: cut benefits, raise taxes on a shrinking worker base, run deficits, or accept declining living standards for the elderly. The economic model China pursued assumed continuous population growth. Build apartments for new families, build factories for new workers, build infrastructure for expanding cities. When population contracts, this model reverses: empty apartments, idle factories, underutilized infrastructure. Debt remains from the building, but the population to use the assets and generate returns to service the debt has vanished. China's total debt exceeds 300% of GDP, according to Bank for International Settlements data. This figure includes government debt, corporate debt, and household debt. It does not fully capture the shadow banking system, off-balance sheet, local government obligations, or informal lending. The debt accumulated in layers over 2 decades. Each economic slowdown triggered a stimulus response. Each stimulus relied on credit expansion. The debt load grew faster than the economy it was supposed to support. Central government debt appears manageable at roughly 80% of GDP. This figure misleads. Local governments carry separate obligations, both explicit bond issuance and implicit guarantees to local government financing vehicles. LGFVs borrowed to fund infrastructure projects local governments wanted but could not directly finance. The projects include roads, bridges, industrial parks, and new urban districts. Estimates of LGFV debt range from $7 trillion to $13 trillion. Some of this debt funds productive infrastructure. Much funds projects generating minimal returns. Ghost cities across interior provinces stand as monuments to debt-funded construction without economic justification. Corporate debt in China exceeds 160% of GDP. State-owned enterprises carry substantial portions of this load. SOE efficiency lags private firms, but SOEs access credit on preferential terms. Banks channel funds to SOEs because implicit government guarantees make the loans appear safe. Private firms, often more productive, face tighter credit conditions. The property sector concentrated corporate debt in vulnerable structures. Developer borrowing against future apartment sales created a chain of obligations stretching across the financial system. When developers defaulted, banks absorbed losses. Trust companies, the core of China's shadow banking system, absorbed losses. Individual investors who purchased wealth management products backed by developer loans absorbed losses. Shadow banking grew as a mechanism to circumvent official lending limits. Banks wanted to make loans that regulations prohibited. Trust companies, wealth management products, and entrusted loans allowed credit creation outside official channels. At peak, China's shadow banking system approached $13 trillion in assets. Households increased debt during the property boom. Mortgage debt reached 40% of household disposable income in debt service payments. This ratio exceeds levels seen in America before the 2008 crisis. Chinese households financed mortgages expecting apartment values to rise. When values fell, the debt remained. The People's Bank of China expanded its balance sheet to absorb stress. PBOC assets grew from $2 trillion in 2008 to over $6 trillion by 2023. The central bank provided liquidity to banks facing pressure, purchased government bonds to fund deficits, and managed the exchange rate to prevent capital flight. Capital controls prevent the free exit of money from China. These controls contain pressure that would otherwise force adjustment. In a system with free capital flow, investors fleeing Chinese assets would cause currency depreciation, forcing domestic adjustment. China's capital controls allow imbalances to persist longer, building greater eventual pressure. The 1997 Asian financial crisis demonstrated the danger of debt in systems with pegged currencies. Thailand, Indonesia, South Korea, and Malaysia maintained currency pegs while accumulating dollar-denominated debt. When confidence broke, capital fled, currencies collapsed, and dollar debts became impossible to service. China's capital controls provide protection against this specific sequence, but they create different vulnerabilities. Richard Ku's balance sheet recession framework applies to China's current situation. When assets fall below liabilities across the economy, all economic actors attempt to pay down debt simultaneously. This collective deleveraging removes demand from the economy. Monetary policy cannot fix the problem because no one wants to borrow regardless of interest rates. Fiscal policy helps temporarily but creates its own debt burden. Japan demonstrated that balance sheet recessions can persist for decades. The United States, after 2008, experienced a milder version, with household deleveraging suppressing growth for years despite aggressive monetary stimulus. China faces a version combining household, corporate, and local government deleveraging simultaneously. The policy options narrow. Stimulus funded by more debt adds to the burden requiring future deleveraging. Allowing defaults clears bad debt but destroys wealth and threatens social stability. Inflation erodes debt burdens but punishes savers, particularly the growing elderly population. Currency devaluation improves export competitiveness but risks capital flight and import cost increases. Beijing has chosen to extend and pretend, roll over maturing debts, provide liquidity to prevent acute defaults, stretch the adjustment over decades rather than forcing rapid correction. This approach follows the Japanese template, accepting prolonged stagnation over disruptive adjustment. When China sneezes, the world catches cold. This cliché contains economic truth you will feel in your daily life. China's crisis transmits through trade, commodity markets, financial linkages, and supply chain disruptions to reach your wallet, your job, and your government's fiscal position. Trade channels move first. China imports over $500 billion annually in goods from the rest of the world. As Chinese growth slows, these imports decline. German automakers sell fewer cars. Australian miners ship less iron ore. Brazilian farmers export fewer soybeans. American semiconductor companies book lower revenues. Each reduction flows through to employment, investment, and tax receipts in exporting nations. China manufactures approximately 30% of global goods. This concentration creates dependency your economy cannot easily escape. Consumer electronics, furniture, clothing, toys, auto parts, industrial components, and pharmaceutical ingredients flow from Chinese factories to global consumers. When Chinese production disrupts, prices rise and availability falls. The COVID-19 pandemic previewed this transmission. Factory shutdowns in China created global shortages. Prices for goods dependent on Chinese supply chains spiked. Years later, companies continue efforts to diversify supply chains away from China concentration. These efforts cost money, raising production costs and consumer prices. Commodity markets transmit Chinese demand changes directly to global prices. China consumes 50% of global steel production, 50% of copper, 60% of concrete, and similar proportions of other industrial metals. When Chinese construction slows, metal demand falls, and prices drop. Resource exporting nations from Australia to Chile to South Africa see government revenues decline. Energy markets face complex transmission. China imports 70% of its oil consumption. Reduced Chinese economic activity means reduced oil demand. This should lower global oil prices, providing relief to importing nations. Geopolitical complications intervene. China purchases oil from Russia, Iran, and Venezuela under sanctions or outside Western pricing mechanisms. A weakening China may purchase more discounted Russian oil, altering global flow patterns. Financial linkages spread stress through banking and investment channels. Global banks hold exposure to Chinese corporate and sovereign debt. Investment funds marketed to retail investors in Western nations contain Chinese equities and bonds. When Chinese assets fall in value, these funds generate losses for investors who may not realize their China exposure. The Belt and Road Initiative created lending exposure across developing nations. China loaned over $800 billion to countries in Asia, Africa, and Latin America for infrastructure projects. As China's domestic financial stress grows, Beijing has less capacity to extend new loans or forgive existing ones. Debtor nations face demands for repayment at moments of their own financial stress. De-dollarization timelines shift with China's economic trajectory. Beijing promoted alternatives to dollar-denominated trade and reserves as part of challenging American financial hegemony. A weakening China undermines this effort. Currency strength requires economic confidence. Investors fleeing Chinese assets seek safety in dollars, reinforcing rather than weakening dollar dominance. Geopolitical calculations intertwine with economic ones. Taiwan represents a flashpoint where economic and security interests collide. A weakening Chinese economy removes some resource base for military adventures, but may also increase domestic pressure on leadership to generate nationalist rallying points. Your security environment changes based on how Beijing manages economic decline. Supply chain reconfiguration will define the next decade of global manufacturing. Companies are moving production from China to Vietnam, India, Mexico, and other locations. This transition costs money, takes years, and raises production costs. Products you purchase will cost more as a result. Jobs may shift within your economy as manufacturing patterns change. Investment returns will reflect China's trajectory. Index funds holding emerging market or global equities contain Chinese companies. Real estate investment trusts with Asian exposure face write-downs. Commodity producers in your nation's stock market fall when Chinese demand weakens. Your retirement funds, if diversified globally, hold China exposure you may not have chosen. Government fiscal positions shift with trade and tax impacts. Reduced exports to China mean lower corporate profits, reducing tax receipts. Reduced economic activity means lower employment taxes. Governments face revenue pressures at moments when domestic populations may need support due to economic disruption. The 2008 financial crisis demonstrated how American housing market stress transmitted globally through financial and trade linkages. China's crisis transmits through similar mechanisms on potentially larger scale. China's economy is larger than America's was in 2008 relative to global output. China's integration into global supply chains exceeds America's manufacturing integration. You will feel China's economic crisis in the prices you pay for goods, the returns on your investments, the security of your employment, the fiscal position of your government, and the geopolitical stability of your region. This is not a distant event happening to other people. This is a global economic transformation affecting everyone, integrated into the world economy. The historical pattern suggests decades of adjustment. Japan took 34 years to recover stock market highs, and still has not recovered real estate values. China's adjustment may extend similarly. The scale is larger, the starting position is less wealthy. The demographic decline is steeper. The political system faces different pressures. Economic miracles end. They end because the conditions that created them exhaust themselves. China's export market saturated, its property market overbuilt, its demographics inverted, its debt accumulated. Each pillar of the growth model cracked under accumulated stress. History offers no example of a nation navigating this combination of challenges without prolonged stagnation or disruption. China may prove exceptional. It may find pathways Japan did not. It may leverage state capacity in ways market economies cannot. The data available today does not support optimistic projections. The comparison in this video's title asked whether Japan 1990 and China 2024 represent the same bubble and the same collapse. The documented evidence shows structural parallels in asset bubble formation, demographic timing, debt accumulation, and policy constraints. The scale differs. The political system differs. The global integration differs. The underlying dynamics appear consistent. You now possess the framework to interpret headlines about China over the coming years. Each report of developer default, property price decline, demographic data release, or policy stimulus fits into the structure outlined here. The crisis is documented, the trajectory is visible, the implications are global. Your money, your job, and your future connect to decisions made in Beijing, defaults processed in Shanghai, and babies not born in Shenzhen. The boundaries between domestic and foreign economies dissolved decades ago. What happens in China does not stay in China. The machinery of Chinese growth is winding down. The infrastructure, bottlenecks, and leverage that created 3 decades of expansion now reverse direction. The concentration of economic power shifts as China's rise plateaus. The extraction of value moves to new locations. The gatekeepers of global trade adapt to changed conditions. This is Rashii historical. We trace the money, expose the systems, and connect the history they never taught you to the future you will live through.